The home buying process is fairly straightforward, but there are lots of steps along the way. One thing to keep in mind is that our local market tends to be competitive with multiple offer situations, so as a home buyer, you need to be prepared. Being prepared will make your offer stronger, protect you from risk, and ensure a successful home buying experience. Hi, I'm Vinicius Brasil with the Brasil Group in Keller Williams. I've been in residential real estate here in the Bay Area for about 20 years, helping buyers make great home buying decisions. This video is part of our home buyer series, Everything You Need to Know Before You Buy a Home. As I break down the home buying process, we are going to talk about perhaps the most important detail of buying a home, financing. It's important to start off with financing so you can start to develop an idea of costs and create a budget for your new home. Financing involves lenders, interest rates, closing costs, and pre-approvals. Understanding all these will help you make the right decision when securing financing for your new home. Let's start with pre-approvals, as they're critical in our competitive market. A pre-approval is basically a lender vouching for your creditworthiness. It's not a loan commitment or a promise, but rather a lending conferring what they can loan you based on your income, assets, debt, and your credit. The real loan approval process comes after you have an accepted contract on a home, but having a pre-approval is critical to show home sellers that a lender has vetted you and feels that you're creditworthy. With that said, there are a number of different types of pre-approvals, so you need to know the difference and which one a seller is going to prefer. The pre-qual is perhaps the easiest and the quickest turnaround. The pre-qual pretty much is just you telling your lender how much money you make, what your assets are, and what your debt. They don't even need to check your credit on a pre-qual. The turnaround is quick. You can get it within a few minutes, and it'll give you an idea of what amount of loan you could be qualified for. As you can imagine, this type of approval is not the best. An actual pre-approval is much more involved. It's going to require that the lender collect pay stubs, tax statements, verify your accounts, check your credit, and after verifying all this information, they're going to submit it into their program, and it's going to spit out a pre-approval, which will tell you the amount of loan that you're going to be pre-approved for. Some lenders may be able to provide this the same day, but it can take as much as 1 to 2 days. This type of pre-approval is a lot more secure than the pre-qual because they're actually verifying the information and checking your credit. The last type of pre-approval, and perhaps the most secure and most reliable, is the underwritten pre-approval. Like your pre-approval, you're going to have to provide the documentation for your income, debt. They're going to have to run your credit, but all this information will not only be collected by your lender, but once they've submitted all these details into the system, it's going to be reviewed by another party, which is the underwriter. This whole process can take as much as a week to get a result back, and typically there may be a few conditions that you need to get resolved in order to be pre-approved. Because your file is being looked through by an underwriter, there's more scrutiny, and therefore it's more secure and reliable because it's been vetted by an underwriter. And the likelihood is that you won't have any issues when you're being approved. Another important detail to understand is your loan costs, which are going to be due at closing. Loan costs are what the lender will charge you for all the processing and preparation of the loan. These fees will consist of underwriting fees, processing fees, appraisal fees, credit report, flood certs, tax service fees, lender's title insurance, as well as some additional fees that your lender may charge you. It's important to understand what your lender is going to charge, and your lender is obligated to provide you the information of these fees up front. There are several different types of loans to think about. There's fixed rate mortgages as well as adjustable rate mortgages. A fixed rate mortgage is a mortgage that has a fixed rate for the entire duration of the loan. So you might have a loan that's amortized for 30 years with an interest rate at, say, 5%. Well, that means that interest rate will be 5% for the life of the loan. An adjustable rate mortgage is a mortgage where the loan may adjust depending upon where rates are after the fixed portion of the loan expires. Adjustable rate mortgages can be fixed for 3, 5, 7, or even 10 years. Why would you use an adjustable rate mortgage? Well, typically adjustable rate mortgages have lower interest rates for those fixed periods, but because of the risks and because they will adjust, adjustable rate mortgages typically have lower rates than fixed rate mortgages, and therefore they can be more attractive. Why would you use an adjustable rate mortgage? Perhaps you think that rates will drop in the next few years. It doesn't make sense to lock in a 30-year rate. Depending upon how soon you think those rates will drop, you may want to select a 3, a 5, or 7-year fix. Another thing to understand about financing are the type of lenders that are out there making mortgages. There are the traditional banks such as Wells Fargo, Chase, B of A. These banks are exactly what you would imagine when you think of a bank. They're big institutions that collect deposits and they make loans that they may sell on the secondary market to buyers like Fannie Mae, which enables them to free up more cash and make more loans. With a traditional bank, you can often get a pretty good deal when it comes to fees, since there's no middlemen to pay, and a competitive lending rate. However, if you're looking for a special homebuyer program, you'll find that these banks don't have a lot of variety in terms of programs. They can also be pretty picky when it comes to borrowers, and they may not be willing to overlook blimps on your credit report. In addition to traditional banks, there's credit unions. Credit unions have really started to compete in this space. A credit union can be a valuable asset when it comes to securing a loan. Like a traditional bank, they typically loan their own money or the money of the credit union in their network. But unlike a traditional bank, they can often make unusual types of loans for specific circumstances. What each credit union will do can and will vary depending on credit unions. The fees of a credit union will typically be on the low side, but you may find that credit unions are a bit slower and a bit more tedious since they may not make very many loans per year compared to traditional banks. This isn't a bad thing, but it's something just to be aware of in case you need a quick close. And in a competitive market, sometimes sellers want a quick close. Lastly, there are mortgage brokers. Mortgage brokers can offer more flexible products for your situation and can generally shop around. They might be more expensive than traditional banks or credit unions, but the downside is they won't be able to provide an underwritten pre-approval. Mortgage brokers often get a bad rap, but they can be very useful if you're looking into different kinds of programs to help with things like down payment assistance or loans that are more forgiving of credit issues or high debt to income ratios. You'll typically pay a higher fee for using a mortgage broker, but sometimes the fee is worth the value they bring. Unlike with the traditional bank, mortgage brokers can match with your loans from a portfolio of banks, making it easier for borrowers to secure the mortgage loans they're after. They can also often close very quickly since they should know which lenders can move quickly and which are slower to respond. Another downside is since they act as a broker, they don't have access to the lender's underwriters, and therefore they can't provide an underwritten pre-approval. To recap, your first step in the home buying process is to secure your financing. You do that by getting pre-approved, but make sure you're getting an underwritten pre-approval. Lastly, you want to be aware of the different lenders and loan products and what they mean and how they can affect you. Thanks again for watching. I'm Vinicius Brazil with the Brazil Group and Keller Williams, and be sure to watch the next step in our home buying process, working with an agent.